All right, this week, thanks for joining us. We're going to take a look at housing. It's a lot of questions on what's happening in the housing market, what are the trends currently, where sort of the puck is headed with housing. It's a big item for most people to consider purchasing a home or moving, and there are a lot of things going on in the housing market that I think are worth discussing. We're going to take a deep dive on this. We'll have multiple videos on this, but today we just want to sort of introduce the current state of the market, what's going on, what's driving sort of the price increases, and how we see them evolving from here. Take a look at the current housing market based on existing sales. And Mike, why don't you take us through what we have here?
Yeah, nice primer slide here. What we're looking at, the blue line, is the year-over-year change in the S&P CoreLogic Case-Shiller National Home Price Index. And this goes all the way back to 2000. So it'll allow us to compare and contrast this rise in prices that we're seeing now, home prices nationally up 18.8% through the end of January, versus the rise in home prices we saw in the 2000s. And there were very different drivers that we're going to want to sort of unpack and discuss. So, everybody knows what drove house price appreciation in the 2000s. So speculation, origination, securitization. I'm sure we could dig into all those in more detail, but there are movies on this now, so we don't really need to spend much time there. And you can see the level of existing sales and housing starts in the green line. So those are monthly, but at an annual rate. So a lot of selling activity and a lot of new homes being built in the 2000s, a full housing boom. And, on the margin, first-time home buyers and multiple home buyers were really driving demand there. Investment properties, lots of individuals having multiple homes. Then we obviously know what happened. 2008 global financial crisis totally reset the market. We went through about a decade of recalibration, and then COVID happened. And COVID created a lot more trends that we need to talk about. The first, obviously, was money creation, which we have covered in depth. So the amount of money that was created in that short of a period of time, resulting in much higher wealth, much higher income. So it gave home buyers the ability to change where they lived and move up in housing.
And a desire to live in a bigger space.
Exactly, yeah. And to that second bullet point, migration. So migration out of urban areas into rural areas, out of apartments into single family homes, out of the center more into the coasts. You could also say out of blue states into red states. That has created a lot of movement and dislocation within the housing market as well. And then the last factor that at this point we think is probably the primary driver is institutional investors, the institutional buyer. Basically, a new investment asset class has really been created or come into vogue, if you will, since COVID, and that's the single-family rental market. Investors buying up homes, and single-family homes in mass, and renting them out.
Describe, because it's a little different than back in the early 2000s. It was individuals investing in homes. I'm going to buy 4 or 5 homes. I'm going to flip them, or I'm going to rent them. You're talking institutional investors. Describe who these people are, because they weren't around back then.
Yeah, these are large real estate investment trusts that have equity investors. A lot of them are large banks and other financial institutions, hedge funds, things like that. And they're buying 80,000 single-family homes and renting them out. In a lot of markets like Jacksonville, Atlanta, places like that, right now they're buying 30% of all home sales are going to institutional buyers. So, these REITs like Invitation Homes, for example, they are your landlord. Particularly in low to middle priced homes, that's sort of the bread and butter here for these big institutional buyers.
Yeah, it's a big change from before. So
yeah,
let's move on to the next slide and talk about home buyer affordability and what's changed dramatically just recently.
Yeah. This is very interesting because everybody looks at the rise in home prices and says, well, this isn't sustainable because affordability, houses are becoming much less affordable, and first-time buyers are getting priced out, so that should cool prices. And that thesis is correct. It's supported by the data. So if you look at the primary home buyer affordability inputs, and we can just sort of take them one by one, and we look at how they've changed since pre-COVID through the end of 2021, median family income has gone up about $5,000. So that's a 7% change. That's great. That's great for affordability. It makes homes more affordable, all else equal, but all else is not equal. The median existing single-family home price has gone up 32%. And mortgage rates, that was one thing homebuyers had going for them, was that they were actually lower than they were pre-COVID, but that was as of 12/31/2021. Now it's more like it's over 4% is the national average for a 30-year fixed. So your mortgage rate is higher, which means your principal and interest payment is 22% higher than it was pre-COVID, and your payment as a percentage of income is 14% higher. So overall, houses are not very affordable for individual buyers. The affordability index has gone down 20 points, 12%, implying homes are much more expensive. And that's assuming you can compete and get a house.
Right. So explain that, because with the institutional buyers, they present a different challenge for these in this sub-$1 million market here.
Yeah. Institutional buyers aren't thinking about a 20% down payment. I have to get a mortgage. Can I come to closing and make this work? Institutional buyers are coming with all cash. I mean, they don't borrow in a traditional mortgage capacity. So all of this assumes, this homebuyer affordability assumes you can buy a house, but you're going to have to compete with all cash offers in extremely competitive markets where houses are only on the market for 20 days or less, in some areas far less than that. So you might have to get a pocket listing to get lucky. So you're getting priced out. And first-time buyers, I mean, you're going to have to come with a big down payment, and there's no way you can compete with an all-cash offer. So increasingly, they're getting priced out as well.
So a lot of people would think that housing prices should come down because they've gone up so much so quickly. However, there's a couple things that would suggest otherwise. And the next one on the next graph is the institutional buyer, but there's also a supply issue. So I want you to tackle both of those.
Definitely. So this chart we're looking at here, this is the share of home purchases from institutional buyers. You can see back in the 2000s, institutional investors, I mean, they weren't really impactful at all, buying anywhere from 6 to 10%. But now, during Q4 2021, buying 18%. And during January, we've seen numbers, over 20% of home sales are going to institutional investors. And it's important to note, institutional investors have a far different set of criteria they use to determine, is this a good investment, than you would if you were to go buy a home, for example. So, for example, the current price of the home, it doesn't matter that much to them, because how they're thinking about it is, I need to buy a lot of homes because I have investors that I need to make happy. I have this money earmarked, whether I've raised money in terms of equity financing, or I've got a 5-year revolving credit facility with an interest rate of 1 to 2%, or I'm issuing bonds in the BBB debt market for 3% or less. I have money I need to put to work. And okay, I'll go ahead and take a $500,000 home, and maybe I'll overpay by $100,000 to make sure I get it. So now the home I just purchased costs $600,000, but I'm going to rent that out, make about a 65% profit margin on the rent relative to the carrying costs and the maintenance costs and things like that. Oh, and by the way, I'm going to lever it up 6 times. And so that's how these institutional investors operate. And if you do that, what you get is a yield that's much more attractive than, for example, high quality bonds.
Right.
So as an asset class for an institutional investor, this is great. I get a much more attractive yield, and the yield is based on the rents I can charge my renters,
right,
which happens to have gone up over 10% over the past year and tends to rise with inflation. So as an institutional investor, you're looking at this and saying, okay, the price today that I pay for these things doesn't matter that much. I want a nice yield that grows with inflation that's better than I can get in the bond market. And that's how they're thinking about this. So institutional investors have not been priced out of the market. They are still going to be there. There's still capital flowing here.
As evidence would suggest, they're getting more active.
Exactly.
These recent sales. And this could support mid-teens or at least double-digit price increases for the next several years.
Right. And so then you talk about supply shortages. So the next release valve here would be, well, we should just build way more homes. We need more homes. And we do need more homes, obviously, but there are a lot of issues right now in trying to build a home. Supply chain issues are running rampant. Even if home builders could or wanted to rapidly increase the supply of new homes, they just can't.
Yeah.
Parts problems, labor problems,
permit problems. Permits are taking 5 or 6 times what they used to take.
Yeah, the cost of land, being able to pass that on, all of these issues.
Yeah. So what's the tipping point here for institutional investors where they aren't as active in the market?
Yeah. For them, it's a yield trade-off. How much is my cost of financing? So how much can I issue debt for? What is my revolving credit facility? What's my cost of capital from an equity perspective? Versus what's my sort of rent yield or net operating income when I rent this out? That's the difference. And it doesn't have to be big if you can lever it up 6 times. So remember that. So right now, that's still an attractive trade-off. It makes sense. They're going to have to be more strategic in terms of where they buy homes, so they're not overpaying in super rich markets. But as long as they get that positive yield, this works. So when would that positive yield go away? Well, if they can't pass on higher rents to the folks that are renting those homes, if the operating costs of those homes become too high, so for example, taxes, repairs, maintenance, if that type of inflation eats into their profit margin, all of those could flip the equation, and now it wouldn't make sense to, overpay by $100,000 on a $500,000 home.
Right. And in terms of those factors, what does that do to the individual buyer if you're saying that carrying cost increases?
Yeah. I mean, if institutional investors are getting priced out of the market, then individual buyers got priced out a long time, right? Long time ago. And also, if you're not buying a home, you just own a home, well, you're seeing cost of maintenance for your house go up, and your carrying costs go up as well. Right. So it's not good news for anybody. It all goes towards softening the housing market and softening consumption and demand. If institutional investors stop buying because it doesn't make sense, that means a lot of stuff doesn't make sense for a lot of other people in the market.
Yeah, for sure. And maybe just one last question. Like I said, we have a lot more to dig into here, but one last question maybe for this is, what are the social implications of this large of a buyer now coming into the market and being here for a while?
Yeah.
And sort of converting or pushing the unaffordability of housing for entry-level buyers.
Yeah. Well, for a long time, especially pre-global financial crisis, home ownership in the U.S. was a path to prosperity. And it was something that was a bipartisan issue, and incentives were created in Washington to allow people to achieve the American dream and own a home. And increasingly, it's just very, very hard to do that, especially generationally for the folks that are trying to buy a home now. And why can't they do that? Well, because big investors, hedge funds, private equity, REITs, they're snatching up all the homes and want to make me a renter for my entire life, for example, is how somebody would think about it. Right. And so there probably are social ramifications for that. We've seen class action lawsuits against a lot of these single family home REITs about things like, they're not making repairs to the homes. Right. I can't buy a home. So there are definitely going to be repercussions, and it'll be interesting to see how the incentives change and how sort of the biases and incentives offered by Washington change over time.
Yeah, absolutely. And maybe one last question, since we have a few minutes here left. People are probably familiar with Zillow. Yeah. They spectacularly crashed their attempt to participate in this market. Can you give some perspective on what they did and what went wrong there and how it might impact other people in the space?
Yeah. So institutional buyers, another reason why they're playing a bigger role now is because technology has improved so much. You think if I need to go buy 20,000 homes, well, that's really hard for me to just go do due diligence on 20,000 homes all over the place. But big data, technology, now I can make this, I can sort of create an algorithm. It'll tell me how much I should pay for a home, and I can do this all sort of remotely. And so Zillow, for example, big data on housing prices is sort of their business. And so they had an iBuying program where they bought a lot of houses very quickly. And their algorithm was basically suggesting, well, I can buy something that needs a facelift. And that will give me a higher return on investment, right? And they bought a lot of those homes that needed facelifts. And the problem they ran into was the cost to get those facelifts completed and the supply chain issues trying to hire people to do this maintenance. It was basically impossible. Yeah. And so they're sitting on all these homes that they're not renting out, and they're getting killed by the carrying costs over time. And they basically had to put an end to the entire business. So they are not participating in the iBuyer market anymore.
And what was interesting about that is they were able to unload all of those properties almost without any incident and fairly quickly to other institutional buyers.
Yeah.
So remains to be seen how this unfolds, but it definitely is a different housing world going forward.
Yep.
All right. Well, thanks for joining us today. We'll look forward to sort of part 2 and part 3, perhaps, of the housing market deep dive.